Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. There have been quite a few data points between today and Wednesday. RBI's dividend of 2.11 lakh crore for the government. Now, this number is making the rounds because expectation was of only 1.02 lakh crore. Apart from that, the US dollar once again has been stronger globally. Fed minutes release continue to reiterate the higher for longer theme. Good morning, JK. Lots for you to cover. Jump in yields, RBI's dividend, Indian equities at fresh eyes. How are you reading the overall markets?
Hey, good morning. Uh, yeah, the story of the day is the spike up in yields and resultant renewed strength of the dollar. Actually, there have been quite a few reasons for the yields to rise in the last 2 days. Higher inflation in UK than expected, then hawkish Fed minutes, very strong PMI surveys in the US, reversing the downtrend that was seen last month. And also we had jobless claims which fell for the second week in succession. It had seen a high of 2,31,000 2 weeks back, and then now it is back at 2,15,000, and expectation was for 2,20,000. Now, we had a series of weak numbers from US in the past few weeks, which had led many to believe that the economy is slowing significantly. But yesterday's survey results and jobless claims have changed the sentiment, helping dollar to recover by nearly 0.75%. A significant retracement for the euro, and Japanese yen traded above 157 as well. Chinese yuan's gradual weakness was maintained as we moved towards 7.26, and central bank fixing was above 7.11 after nearly a month. Now markets are now pricing in only a 53% chance of a rate cut in September. So there's been quite a bit of volatility in the expectation itself as far as the September rate cut by Fed is concerned. In fact, for several months also, and that is actually down from 67% a week ago. We had yields going up for a 2-year by 8 basis points and 10-year by 7 basis points after the above numbers. Now, although the data from other regions like Europe and the UK was also positive, the data from US where manufacturing and services actually both rose, and persistent views of several members hinting at higher for longer have eroded the positive impact of lower inflation that was seen last week. So that's why we have seen the market moves. As mentioned above, stocks had a steep fall, Dow losing 1.5%, S&P 0.75, Nasdaq 0.4%, despite forecast beating result from the NVDIA, the most watched AI sector stock. Now, move back in the dollar confirms that we are still in a broad range between 103 and 106. Metals falling was justified as they looked overbought due to sharp rally in a very short period of time. Expect this range in the dollar to continue into the month of June, when major central banks are expected to deliver their monetary policy decisions. Now, India's exceptionalism has stood out in the last few days. We saw, as you said, record dividend payout by RBI, 2.11 lakh crore, almost double of what was being expected by and factored in by the government. Now, what it led to was Indian benchmark 10-year yield falling below 7%, almost 10 basis points fall in the last 2 days. We had turned in the FI flow strongly to the positive side, almost 500 million yesterday in yesterday's session alone. We also had a PMI survey in India pointing to continued strength both in manufacturing and services activity levels. Stock market, as you also mentioned, hit a new all-time high in India yesterday. Now, only a renewed strength in dollar index can keep the rupee from any sort of weakness until the June election results. Yes, the development in dividend side can lead to bond index related flows for the market, hastening, helping rupee to trade firm, although RBI is expected to absorb the related flows. And the other positive development is the turn of the FI flows, as I mentioned. So these factors are definitely keeping the rupee below 83.30 in the offshore trades, but maybe it will start to inch up. Maybe oil companies buying and RBI themselves, mopping up flows, keeping the market stable. So on a more medium-term basis, India's macros have been steady. Lower CAD, BOP surplus, higher GDP, falling fiscal deficit all favor a stronger rupee. But such a development will have to await the outcome of general elections. Fed's monetary policy will have its own influence, and they are maintaining higher for longer regime can be deterrent to big strength in the rupee, even with a positive result from the elections. Now, near-term target I am keeping at 83.20 to 83.50, and for the eventful month of June, I should expect 80 to 70 and 84 range. That's it. Have a good weekend. Thank you.
Thank you, JK. And just reiterating India's exceptionalism, and that has stood out with the record dividend payout, double of what the markets were expecting. We had a fall in the Indian 10-year benchmark yield below 7% mark. Now that is quite significant. And stock markets also hit fresh all-time highs. When it comes to the global markets, there is a sort of change in theme. In the past few weeks, we had been observing weaker economic numbers from the US, which has now reversed as now data seems to be coming out on the stronger side for the US economy, as shown by the PMI numbers, of course. This has, of course, led to September rate cut expectations coming down to nearly 50%. That's it from us today. Have a very good weekend, and thanks for listening. Tune in on Monday for the latest in the financial markets.